Banks, we are cash flow lenders first. I think everyone's heard the term cash is king.
Yep.
That's very much true in banking, and it's usually the first thing that we look at. And we always want to ensure that the cash flow available to service debt is sufficient to cover the proposed annual debt service. And the way we do that is we calculate EBITDA, which means earnings before interest, taxes, depreciation, and amortization. And then we usually subtract what the expected distributions would be. And then if there's any capital expenditures, we'll deduct that as well. And that gets you your cash flow available to service debt. So that's your numerator. And then you divide that number by what your proposed annual debt service would be. So that would be, let's say you do an SBA loan, $1 million loan, it amortizes over 10 years. Your annual debt service would be $100,000 plus whatever your interest payment would be. And usually banks want to see that the company has sufficient cash flow to service that debt by a margin of, we'll call it 10 to 15 points. And I'm sure some of you who are listening to this have heard of the, debt service coverage ratio or fixed charge coverage ratio. That's kind of the holy grail of bank covenants. So that's usually the first thing we do. And then banks, our secondary source of repayment is always collateral. So that's usually the second thing we'll look at. And if you think collateral for companies, it's most commonly accounts receivable, inventory, real estate, if you're buying any real estate, and then equipment. And then some other forms would be investment accounts, cash surrender value of life insurance or land. Mm-hmm. And then the third source of repayment is personal guarantees. A lot of times entrepreneurs, they'll want to buy a business and they won't want to guarantee the debt. But if the cash flow, isn't sufficient in any of the, past 3 years, or the day one balance sheet or cash flow leverage won't be great, then usually that's when a bank asks for personal guarantees. And then lastly, banks just tie it all together, and we create a risk rating model. And that risk rating model also kind of directs, what kind of pricing you get on the deal.